As an expert financial analyst, I have conducted a comprehensive comparative analysis of Palantir Technologies, PLTR, against its key competitors in the data and AI software sector. This analysis relies on the most recent available annual or trailing 12 months (TTM) data to provide a clear picture of Palantir's financial standing relative to its peers. 2. Ratio analysis and comparison. The following table presents a side-by-side comparison of 15 key financial ratios. Note that some values may be negative or not applicable, NA, for certain companies, particularly those in earlier growth stages like Snowflake and C3.ai, which may not yet be consistently profitable. For large diversified tech companies like Microsoft and Alphabet, the data reflects their entire business, not just their AI or cloud segments. Ratio interpretations, PE ratio, Palantir's, PLTR. PE of 163.6 is exceptionally high, indicating that investors are paying a massive premium for its earnings. This is a key contrast to established giants like IBM and Oracle, whose PE ratios are in the 20s-30s. Palantir's high PE is a sign of immense growth expectations, similar to Snowflake and C3.ai, which have negative PEs, signifying they are not yet consistently profitable. PS ratio. Palantir's PS of 20.3 is on par with Snowflake, another high-growth pure-play data company. Gross margin. At 81.3%, Palantir's gross margin is a major strength. It's among the highest in the peer group, demonstrating the company's ability to generate revenue at a low cost. This indicates a highly scalable software business model with strong pricing power. Operating margin. Palantir's operating margin of 12.3% is positive, a notable achievement for a growth stage company that was historically unprofitable. This places it ahead of companies like Snowflake, Alteryx, and C3.ai, which are still operating at a loss, but behind the highly profitable tech giants. DE ratio. Palantir's DE ratio of 0.05 is extremely low, suggesting it carries minimal debt relative to its equity. This is a sign of exceptional financial health and a low-risk balance sheet, a major advantage over older tech companies like IBM and Oracle that carry more debt. Free cash flow, FCF. Palantir's FCF is positive and substantial at $818 million. This proves it is a self-sustaining business that generates more cash than it consumes. This is a key differentiator from loss-making companies like Alteryx and C3.ai. EPS growth, YoY. Palantir's EPS growth of 230% is phenomenal, and a clear indicator of its recent transition to profitability and rapid growth. This number is a major driver of its high valuation. Revenue growth, IoY. At 20.3%, Palantir's revenue growth is solid. While not as high as Snowflake, it's a healthy rate that significantly surpasses the low single-digit growth of IBM and the mid-teens growth of Microsoft and Alphabet. 3. Industry context. The data analytics and AI software sector has a wide range of companies, from high-growth startups to mature established players. Valuation ratios. High-growth software companies typically have very high PE and PS ratios. PS ratios can range from 10 to 30 or more for companies with strong growth prospects. Palantir's valuation is at the high end, reflecting its significant perceived opportunity in AI. Profitability ratios. Gross margins are often very high, 70% plus in software, indicating scalability. Operating and net margins vary, with many younger companies sacrificing profitability for growth, leading to negative margins. Palantir's move to positive margins is a critical development. Financial health. Low DE ratios are common among software companies, as they are not as capital-intensive as other industries. The ability to generate positive FCF is a key milestone, and Palantir's strong FCF is a positive sign. 4. Overall assessment based on the collective evidence from these ratios. Palantir Technologies, PLTR, is a company with a premium valuation, robust financial health, and strong growth prospects. Its valuation metrics, particularly the PE and PS ratios, are a testament to high investor expectations for future growth, placing it in the same league as other market darlings like Snowflake. However, unlike some of its peers, Palantir has made a critical transition to profitability, as evidenced by its positive net profit and operating margins and, most importantly, its substantial free cash flow. While its revenue growth isn't the absolute highest in the group, its phenomenal EPS growth and solid margins prove it is a more efficient and financially mature operation than other high-growth competitors. The company's extremely low debt-to-equity ratio provides a strong, low-risk balance sheet. In summary, Palantir is a high-growth company that has begun to demonstrate the financial discipline of a more mature entity, which justifies its premium valuation. It presents a more balanced risk-reward profile than consistently unprofitable high-growth players like C3.ai, while offering higher growth potential than the more stable but slower-growing giants like IBM and Oracle.